decision unless you speak the language of finance, unless you evaluate projects in this kind of a framework. Okay, so in terms of cash flow calculations, I'm going to give you some examples in a few minutes, but let me summarize what I'm going to tell you, and then we can talk about the specifics through that example. The first point is you should use cash flows, not accounting earnings. Because again, accounting earnings are meant for purposes other than decision making. Accounting is really meant as a kind of a checkup to see how you've done. How you've done is not the same thing as how you're going to do. One of the things that I think is apparently not emphasized enough is that when you look at accounting data, you're looking at numbers that are not random variables. They have been realized. There's no uncertainty in what a balance sheet or an income statement says, right? It's about the past. And accountants hate uncertainties. I don't know how many people are accountants here or how many accountants you know, but if you know them, you know there's a certain personality type that gets drawn into that profession. And these are not big risk takers. They want to see order and certainty in what they're doing. That's what a good accountant will do, is to try to understand where to put all the expenses and revenues into the proper boxes so that it all adds up. Accounting is incapable. It is not designed to manage and reflect uncertainty. You've heard the term off-balance sheet item, right? Like, for example, I've spoken before about a credit default swap or a futures contract. If you engage in a futures transaction, the moment you engage in that transaction, what's the NPV of a futures contract? 0, exactly. And as a result, that does not go on the balance sheet because it is neither an asset nor is it a liability. It's both, or neither, depending on how you look at it. It's an off-balance sheet item because it doesn't, where do you put it? It has 0 value. But the point is that entering into one of those agreements has a big impact on your future risk. So accounting, the language of accounting, is not ideally suited for thinking about the future. It's a wonderful method for understanding what happened in the past. And you need to understand that in order to plan for the future. You need to know what your current assets are and what your current liabilities are. But that doesn't tell you where your risks are going to be, and it doesn't allow you to speak about the dynamics of cash flows, because that's not what an accountant's job is. That's not what accounting is designed to do. Right? This is not meant to be a critique of accounting, but simply that you can't use it for purposes that it wasn't ideally designed to serve. So the first point is you've got to use cash flows, not accounting earnings. Second point, you got to use after-tax cash flows. Why? Because you have to pay the taxes. That's one of the, along with death and some other